Two-pot retirement system and its tax effects. Understanding the two-pot retirement system and its tax effects. South Africa rolled out the two-pot retirement system on 1 September 2024. It applies to any South African who has a pension fund, provident fund, or retirement annuity. The two-pot retirement system allows you to access a limited portion of your retirement savings before retirement for emergencies, while the majority of your savings remain preserved. This means the larger part of your savings must stay invested until you reach retirement. The goal of South Africa's new two-pot retirement savings system is to encourage the preservation of retirement fund investments until members retire, while also providing access to a portion of their accumulated savings during their working years. Let's look at each pot in more detail. The vested pot, i.e. funds up to 31 August 2024. Your vested pot comprises your retirement savings up to 31 August 2024. There will be a once-off compulsory transfer of 10% of your retirement savings on 31 August 2024, which is capped at 30,000 Rand to the savings pot. This initial transfer is commonly referred to as seed capital. The rest of your retirement savings up to 31 August 2024 will remain in your vested pot. The vested pot is subject to the old rules for retirement funds, and the new two-pot rules won't apply to it. Savings pot. This pot will hold your seed capital and 1/3 of your retirement contributions, which will automatically go into this pot starting the 1st of September 2024. You can access this pot before retirement if you need to. This aims to provide more flexibility for short-term financial needs. You can draw a minimum of 2,000 Rand from this pot once per year, once per tax year, and there is no maximum limit. So you can draw a minimum of 2,000 Rand from this pot once per year, and there is no maximum limit. Retirement pot. The remaining 2/3 of your retirement contributions will automatically be allocated to this pot. This money is meant to be used when you retire. You cannot access this pot until you reach 55 years of age, except under specific conditions. Although known as the two-pot system, it's sometimes also described as a three-pot system due to the fact that in reality there are 3 separate retirement pots. Tax implications. Withdrawing from your savings pot. A tax directive. When you withdraw money, the fund administrator will need to apply to SARS for a tax directive on your behalf, which will reflect how much tax must be deducted before the funds are paid to you. SARS will issue a tax directive if you are registered for tax and have a valid tax number and are up to date with your tax returns. SARS won't issue the tax directive until both of the above apply. This means if you have outstanding tax returns, you won't be able to access your retirement savings pot until these old tax returns are filled. Tax debt. If you owe SARS any money, this tax debt will be deducted from your two-pot withdrawal and paid to SARS. Marginal tax rate. When you take money out of the savings pot, it is treated as income. This means it is taxed according to your personal income tax rate, just like your salary. If you withdraw a large sum, it might push you into a higher tax bracket, which means you'll pay a higher percentage in taxes on that amount. For example, if you normally earn 370,000 Rand per year and withdraw 50,000 Rand from your savings pot, your total income for the year becomes 420,000 Rand. This will move you from the 26% tax bracket to 31% tax bracket, resulting in a higher tax rate on part of your income. Here's an example. Anna earns 380,000 Rand in the 2025 tax year. She withdraws 25,000 Rand from her savings pot. The fund administrator's fee are 500 Rand. SARS instructs the fund that she has 2,000 Rand tax due. So her total earnings are 380,000 Rand plus 25,000 Rand, which is 405,000 Rand. Her marginal tax rate is 31%. The tax on the two-pot withdrawal will be 31% multiplied by 25,000 Rand. That's the withdrawal from her two-pot system, which is 7,750 Rand. The net amount paid to Anna will be 25,000 minus 7,750 minus 500 Rand, which is the administration fee, minus 2,000 Rand. The 2,000 Rand is the tax that she still had due. The pros: immediate access. You can draw money from this pot once per year. Notice, only once per year, such as for emergency or unexpected expenses. Flexibility. Offers more control over your short-term financial needs. Cons: high taxes. Large withdrawals will lead to higher taxes, which means you will end up paying more than you expected. Risk of spending too soon. Easy access might lead to spending the money before retirement, reducing your savings for the future. Reduces liquidity at retirement. When you retire, the only cash you can withdraw as a lump sum from your savings pot and 1/3 of your vesting pot. Therefore, taking money out early reduces the amount of cash available at retirement. Just repeat that. It reduces the liquidity at retirement. When you retire, the only cash you can withdraw as a lump sum is from your savings pot and 1/3 of your vesting pot. Therefore, taking money out early reduces the amount of cash available at retirement. 550,000 Rand tax-free benefit. This may not be fully used if you don't have enough savings in your pot to withdraw at retirement. Tax implications withdrawing from your retirement pot. The tax rate. You can't access money in your retirement pot until you reach retirement age. Unlike the old rules, you can't access this money if you resign from your job or are retrenched. Therefore, tax payable on this pot is deferred until you actually retire. The two-pot retirement system introduces a new way to manage and access your retirement savings. While the two-pot system offers flexibility, it's crucial to understand that withdrawals from it are taxed at your marginal tax rate and should be reserved for real emergencies. The main goal of your retirement fund is to secure your future, so you should avoid withdrawing from it if possible. If you do not access it, make sure that you plan your withdrawals. If you do need to access it, make sure that you plan your withdrawals and understand how it will affect your taxes and liquidity at retirement.